The seventh one I've mentioned briefly is the valuation. You've decided that you want to go, you have done your gap analysis. You've done your canvas, the canvas led to your transformation plan. You have a transformation plan. You have your financial plan, you have a clear investment plan. You know how much you want to raise, you know how you want to spend it, you know what sort of returns. You've decided that you want to go for equity, and you want then to value your company. You have to do this. And you have to be prepared, and you have to be prepared to find. Most of the companies here, you were not the only one, but you were lousy in terms of fighting for what the value of your company is. And most of the investors, Sumaya was in the same situation. You were not prepared. When you're not prepared, then you have to do, but you say at this point in time, Constantin, it's my first try. I'm sorry to be very direct with you, but most of the startup that comes to investment committee are not prepared. You know, and it doesn't take a lot to be prepared. It doesn't take a lot to understand where you stand, what you value your company, and how you could defend your valuation case, you know, on this. But you need to go through it. You need, even if it's not finance, it's not your business, you need to know how you're going to value your company. Is it $100,000? Is it $200,000? Is it $500 or $1 million? You have some elements in your mind that you need to do, and do your homework before coming in front of the jury that are going to decide not only if they fund you, but also at what value you have to fund it. The better prepared you are, the better deal you get out of it. Yes?
Suggest for entrepreneurs to bridge the gap between the actual, present value of money and the valuation from an investor and valuation from an entrepreneur?
Yeah, I mean, you always have, there is a very easy, I ask, one of the questions that I've asked her is how much time she spent. So she told me 2 years off job. How much time the partner said? 1 year, 2 years, 0.5% off. How much money did you put in your own pocket? This is how much did you raise so far? So we came up, let's say, about $400,000. This is how much today she invested. This is real money. This is real money in terms of either her time or money in terms of money that she raised for. So this is the worst case scenario. The worst case scenario is $400,000 that you could get in. And normally what you do, so this is one way of valuing. And as an investor, this is the worst case. If she gets $400,000 means, she didn't do a great job in terms of selling what? Her future. Because all what she sold is the past. She sold, this is how much time I spent, this is how much, but now what you need to do is you need to sell your future. And the big decision, because the future decides on how much multiple on the investment that you have made so far you had. So the brighter and the cleaner is her future. So what we went in, she said, specifically the question I've asked her is, okay, how many schools? How many schools? When are you going to have these schools? She said, Constantin, 20 schools. By when are you going to have 20 schools? By the end of December, we have 20 schools. How much each school is going to provide in terms of membership fees? She gave me the numbers. I'm not stating because it's confidential on these sort of things. So these are the specific questions. Then after these 20 schools, what is the potential in Lebanon? In terms of total school, 1,000. In terms of your target market, private schools that are here, that are technically savvy, 170 schools. So we go there. So question after question, we zoom in trying to decide. And this is a field I don't know. Education, I'm not exposed to education, but as an investor, you know what are the questions you're going to ask to be able to value. Now, based on her answers, I have in my mind what sort of projections is going to come in. So I do my discount cash flow. So discount cash flow, for those who have not been present in investment management, I had one workshop on this, I had another workshop on this. So each one have a different workshop, is that you look at her projections and then I discount her projection. So she said, Constantin, I'm going to do 100,000 this year, 200,000, then 500,000, 700. Then I ask her about the margins, I ask her about expenses, and then she come up with a certain cash flow. I then discount the cash flow based on what we call a discount rate. And the discount rate is a function about how much I trust you to be able to execute your plan. So this is why at the end of the day, when we put money, when Corinne put money, when Sami puts money, they don't only put money in an idea, they put money because they believe that Rida is the right person. That Rida is a person that has the mindset to be able to implement this. So at the end of the day, we invest in the people. We invest more in the people than in the ideas. And this, if I see that there are some high risk here, because, for instance, government will give her a hard time. To go to the Minister of Education, to convince him to go to in there, might be a lot of pain, and she might not be equipped to be able to do it. Focus on the private sector, make a success story, then you move to the public sector, and then you're trying to do it. Now, all this will give me in my mind what is the risk area. So if I ask Sami, what is for him the return, he will say, I'm expecting return on startup of about 25%. If I ask a private equity company that is more mature and gets to companies that exist in, they say, Constantin, I'm happy with 15% or 20%. Now, this is how much they expect in terms of return. Now, why is this important? Because by asking the question, I validate what she's going to generate. By validating, then I'm trying to size how good she is in implementing, and then I decide whether I'm going to discount by 15%, 20%, 25%. So to answer your question or your question, then this will be a discount cash flow. So we validate the assumptions, we validate what is the risk. Based on the risk, we have a certain discount rate, and then we come up with another valuation. So on one side, one valuation is how much she has spent. 400,000 she has spent. On the other side, when we do the discounting, we might come up to 800 or $1 million that she has spent. And then it's her role about telling us why she believes that actually the market is not only Lebanon, but actually it's the MENA region. And this MENA region is not only 200 or 500 schools, it's really about 10,000 schools that could potentially be done. And then by doing this, she's going to create a community. Once she has the community, she started with Arabic, she could move to French, she could move to other, and then she would have, by selling us a future that is not only Lebanon, not only Arabic, not only private schools, then you start to see, okay, there is a potential, and especially if this potential is not being addressed. So I'm using a case, I didn't know her. 2 days ago, I met her for the first time in my life. But this is a little bit the feedback as an investor, how I looked at her venture. So this is how you value. So you have her valuation, we have our valuation, and then there is discussion that based on what is the potential to transform her business. Yes?
When you're doing the initial valuation, you said you take into consideration how much that person puts, for example, without a job, 2 years working on that project.
Yes.
So let's say it's the exact same idea and the exact same stage. If the person was doing it part-time, does that automatically put the evaluation at a lower value?
I mean, if she would have done it for me, the fact that she has done it full-time for 2 years is a good sign. If she would have done it like 10% of her time on this, I would say, okay, she's not really, there's not skin in the game. You know, she has put skin in the game. She has put 2 years of her life. She decided to stop earning money, and she decided, so there is a whole opportunity cost of her salaries because she believed in it. And 2 years is good enough as an investment that you could do. Rida, how many years have you spent on it? Working on your project? 1 year and a half? 1 year and a half. And before this, when you started, was what, 3 years? So when you started your PhD was what? So it's when you launched your 2012? 2009, when you started the idea, you've put your PhD, you've put that. Okay, so you have basically about 3 to 6 years, depending how you look at the investment that he has done in it. So this is his time. Then there are, of course, his team's time in it. So you come up with a certain value of what the company is. Now, in his case, which is not in your case, there is IP. IP has certain value. IP, you know what IP is? Of course you know. It's intellectual property. And this intellectual property is not necessarily only technology related. You know, so I would tell her what is the platform that she's going to use in terms of e-learning or others. Is this platform unique? Is this something that you could protect or patent? In his case, he can. So patenting is important because if he wants to go global, he has protection. So, but the IP could be different. You know, for instance, in the case of Rima, maybe her grandfather has a recipe that is unique, that nobody can copy, is unique. And she has put something which is unique. This thing, Coca-Cola, for instance, have their brand based on the unique recipe. Nobody knows except a few people in the world. And this has resulted, and not only this, but this is one of the important things on a brand. So your brand is related to your recipe. Your recipe is quite unique and is not copied, so people could come up. So the Senteur d'Orient or others do not have the same quality of soap or the same senteur that you have than I forgot the name of the company. Yeah. Jardin d'Eden. Jardin d'Eden. So Eden's garden. What more beautiful words you need? So it's Jardin d'Eden. So these are things that helps you in terms of adding value to your company. Is what is the intellectual property, or what is the brand that you have, or what is something unique that you could protect that would also increase as an investor. I'm willing to give you a premium. Okay, so these are things that are, so in your case, it's the fact that you have dedicated your entire life in understanding the needs of students and the needs of professors. So this is important because this, nobody has it. Your very few people would have it, and then the willingness to wanting to provide it in a more automated way. So all this is under valuation. Any other questions on valuation? Yes?
If it's a disruptive idea of a traditional market, you increase your risk factor.
Okay, now in the case of Rida, it's disruptive. So it's clearly disruptive, and this is why we liked it. Disruptive means when a number of your ideas are ideas that exist. So what you're taking is, I use the case of Zumal because we decided as Berry Tech Fund 2 to fund it. Zumal, some of you know Zumal. So what they do is they help NGOs raise money. So they raise money and they fund NGOs by doing, they funded a number of well-known, Sami, شو اسمه the group, that is well-known group, singers. What is it? Mashroor Leila. So Mashroor Leila got funded through Zumal. So Zumal helped them raise the funds. This is Mashroor Leila, and then it helped Mashroor Leila go. And so Zumal is what is his value proposition? He basically looked at the U.S. He saw that there is one company doing extremely well. He decided to take it, apply it to Lebanon, make it in the MENA region, and then wait for the people who would come, want to be in the MENA, will buy him out at $100 million, and then he will be happy. Beritech will be happy, and will be able to fund even more businesses. So, and most companies are like him. Most companies are like Abdullah. Abdullah is the owner of Zumal. Then they take the idea and implement it. In the case of Rida, it's breakthrough. So it doesn't exist. So it could fail completely. It's disruptive. This is what we call disruptive. Is you coming up with a completely different way. It was done manually. So imagine I'm here, so automatically he will come and he will put the logo that you want. And based on who is paying the most, he will put the logo that is, so it's a bidding system on when I hold my glass to be able to do it. Based on the disruptive technology. So in his case, your question was, if it's disruptive, the risk factor is higher. The risk factor is higher on him to fail, so my discount rate will automatically be higher. Now, on his favor, he will say, okay, it's disruptive, but look at the size of the market. I forgot the figure. How much is the figure, addressable market?
Today?
Yeah.
10 billion.
10 billion. And in 5 years down the road?
30%, you can say
20 billion. So his market is 20. Today it's done in a manual way or semi-automated way on having. If he cracks the code in doing it automatically, he could have a share of the market, could be a big share of this market. So what he will say, fine, I will use probably a 50% or a 60% discount, which is very high discount because it's very high risk on this case. But there is a huge potential, there is a huge market, and this market is untapped. Yani today the way they do it is ineffective. I mean, they're doing it, but it takes time, it costs a lot of money. So what you do is you increase the discount, but then he will come back and say, Constantin, I'm only taking a very small share, and he's projecting to do $15 million in revenue with, I don't know how much, $5 million in net profit in 3 or 5 years down the road. So based on this, he will say, discount me, no problem, discount me at 50%. This is how much I have, 5 million. You discount it today, you still have a valuation of 3 or 4 or $5 million that he has. $5 million, this guy is straight out of university. He was in Speeds upstairs about a year ago. He went to Speeds. 3 months, they gave him $30,000. He continued, he just finished his PhD, and then he potentially could claim he's sitting on a company that is valued at, I don't want to give numbers because then his ego would balloon and when negotiating with him. But this is a multi-million-dollar company that we're investing in where he is, he's the age of my kids. So it's, okay, which is great. So disruptive, you have high risk, but you have high rewards. The high risk means high discount rate. High discount rate means I will have the valuation, but then he would respond in saying, look, this is the sort of revenue that we could aim if we prove the concept. And yeah, there is. Normally what you do, I've asked the question to Sami. So Sami, for instance, remember, Rima is here. It's her own money, so she's putting in. So she has certain expectation about how much return. Typically, Rima should aim, you as founder should aim minimum of 70 to maybe even 100% return. You as owners, if it works well, this is a sort of return. She goes to a business angel. She comes to Constantin. Constantin likes her idea. In my mind, I would say 50 to 60% I'm expecting in terms of return that I would have from her idea. After Constantin, she goes to Corinne, and Corinne comes with IRN Capital, and she says, okay, I need about $500,000 to $1 million. In Corinne's case, she will say that, I need about, no, Corinne actually is not a good example. She will go probably to Sami because Corinne has a social impact. This is USAID, so they want to encourage women entrepreneurs. So she's willing to take a lower. But Sami is a ruthless investor, right? A venture capital investor. He will say 25 to 30%. Actually, today he will say, not only, he will tell me, Constantin, 50%. You used 50%, but let's say, to be fair, he is 40%. Then we will go to Corinne. Corinne would say 25%. And so she will go into phases. And ultimately, he will go to Mina Capital and to others. And they will say, if I talk to Romain Mathieu, he will tell me, Constantin, 15%. And ultimately, when you get to the stock market, what is the return from the shareholder on the stock market? If you look at the past 100 years, you look at publicly traded companies, and if you invest in these companies in the Dow Jones 100 years ago, you will get on average over 100 years, you get about 11 to 12%. So 11%, 10% is the return that you expect from publicly traded companies. If you start as an entrepreneur, it's probably closer to the 80 to 100% range per year return. If you go to a business angel, 50 to 60. If you go to venture capital, it's about 30 to 40. Then it goes down to 11%. Okay, these are the ranges depending on how you grow your company, depending on how much risk you have, and depending on what is his investment policy. Because at the end of the day, what is her investment policy? So she goes back to the shareholders, and they will say, this is our investment strategy, and this is the return that we expect you to do. So it's not only about financial returns in the case of Corinne. We want you to help women. We want you to help rural areas or agriculture areas. So it's not only focusing on technologies, it's also focusing on non-technology things. Okay, so you have different, depending on these investment criteria, you would have different returns. Any other questions? This is an important subject, and it's a subject that is the least understood by any of the entrepreneurs, because everybody is convinced that they're worth hundreds of millions, and you have to go down to reality. Once you've done this, what do? You basically need to select your investment manager. Selecting your investment manager, I covered it briefly. It is your second most important decision in your life. You know, I forgot the name of your husband, Corinne. Moussa? I met Moussa, so a great guy, you know, so they're a great couple, they get along, and they have 2 children, beautiful children. It's the most. When she's going to set up, and her husband is also a banker, so he understands what, and I'm sure he would relate to the fact that when she's going to set up her own business and deciding, after marrying Moussa, whoever she's going to find as her equity partner will be the second Moussa. So Moussa number 2 in terms of the decision that she will have to take. And I strongly encourage you to spend the time, get to know, find out his family life, find out his businesses, how many ventures he has funded, how many did he exit, did he exit well, did he have any legal lawsuits against him, how is he in the market. So all these questions about him, who is his banker, talk to, so understand, because you are getting in a very close and long relationship with this person. So do your due diligence. Due diligence means ask the questions that he will ask anyway about you. He will ask everything. He will ask you who you are. He will look at your plan. He will look at competitors. He will talk to clients. He will talk to suppliers. You feel that at the end, you feel that, you know, he knows more about me than anybody else. You should do the same thing about him. And this selection is a very important one. And normally you don't spend the time. Now here in Lebanon, you have a luxury. Why do you have a luxury as entrepreneurs? Every what? Everybody knows around. So for instance, you know, Rula came up and I told Rula, I'm interested in finding some investments, some coaches, potential coaches. So she put me in contact. And I mentioned the names. Automatically people would say, no, Constantin, not this one. This one is good, but not this one. And so everybody knows around. So you know who are the right one, who are not the right one. But why is it good for you, beside the fact that it's a closed market? Why is this time a good time for you as entrepreneur? I don't know of any other country that has as many funding opportunities and funding money available for so few entrepreneurs available in the market. What is the number one issue of speed? Speed is an accelerator. Speed is here to give you $30,000 to take 10% share of the company. I was yesterday with Sami and with his team. What is their number one issue?
Finding projects.
They don't have enough companies. They don't have enough companies to go through. We have a very strong value proposition. They don't have enough. So you have a lot of money available for very few ideas. So what is the result? What is the result in Rida's? His ego becomes huge. So all of them, and this is why Sami has palpitation in his heart, because he feels like, you're giving valuation so much of this to these companies where on the basis of just an idea, you are crazy. You're sitting on a potential time bomb. If this is a bubble and this bubble explodes, we will be liable in front of Salemeh and in front of the others that we have poorly spent. And our name, we are on the investment committee. We are the ones signing these equity. Where is Samar? Samar is here. Samar is the one preparing, you know, so these things. So she doesn't have, she prepares, she recommends, and then we're the one who signs. So Samar will be free. She's alone, she's no problem. Who will take the blame? We will take the blame behind it on this. So this is why it's important. As entrepreneur, this is a unique time because you have few good ideas, and you have a lot of money being available. And all of these venture capitalists have also huge egos. So what are they doing? They're trying to compete. So when they compete, what happens? Rida comes, he talks to him, we give him a valuation, he goes to MEVP, then he goes to another, then he goes to another, and he shops around like you would have done when you do this. Same sort of things happen. So what happens is that you have a pricing up. So some are eager. Beritech has been there for 10 years. We funded more than 35 companies. Others have just started. They funded maybe 2 or 3. They need to have a track record behind them. So they're willing to give Rida a valuation which is higher, especially if this has been approved by Beritech. Then he goes and he says, Beritech approved me, can you give me better? And then, so this effect is the dangerous effect for the entrepreneurs, but most importantly for the venture capital fund. Okay? Any questions? Yes?
There's a lot of money, but also what sort of time horizon do you need to dispense that money over what period?
Okay, so normally when you dispense, it goes back to your first question. We dispense this money normally on milestones. So we will give you some, giving this. We know that you won't ask money once.
As a fund, do you have a period?
We have a period. We typically on a fund, if you ask Sami, 5 or 7 years. Initially, 4 to invest and 7 to divest. So 4 to invest, 7 he needs to divest. Now his 7, he asked for an extension of 2 years, yes? To 9 years. Why? Because it takes more time. So to answer your question, we're putting money in you. Normally after 7 years, we should be in a position to be able to exit. And this is an important question because in Lebanon, unfortunately, the exit opportunities are limited. We're not in California. We're not in our neighbors in the south where you have a very developed stock market and very developed VC market. We are in Lebanon where we have 5 or 6. Everybody knows everybody. They know exactly where are the companies that we do. So the exit opportunities to allow Sami to get out of this, because Sami needs to go back to his shareholders. They said we invested $6 million or whatever is the amount in you. We want to get our money back after 7 years. After we agreed to give it to you after 9 years. But you, as a director of this fund, needs to come back to us, give us the money back, and give us some sort of return on it. And the higher the return, the better you will be, and you've done a great job in terms of you and your investment committee in selecting and exiting these companies. So to answer your question, 7 to 9 years to get out. What are the returns? The returns would differ depending if it's venture capital, business angel, or a private equity company. But these exits are important. So this is why when you're looking at your investment partner, the most important question you would ask, not how many have you funded. Funding is the easiest one. Money is available. Ma fi shatara funding. Shatara is coaching, helping him grow, and the shatara is helping him exit, helping you exit. هي الشطارة. Funding, كل واحد بيقول لك I funded this, I funded that, I funded صحتين قلبك. How many did you exit? And then it's a different story. Then we're in the process, we're building up, and in Lebanon, very few have exited. Very few have exited. Sami will be one of the first one to exit, and we're going to exit hopefully over the next few months from several of these. But very few have exited because the money has been very fresh. Beritech is the first one to come 10 years ago to start it, and now you have a number of people. And so, Riyad Salemeh, look at what happened. He said, look, it's a great idea, let's expand it. And he had a great decision by, in some ways, forcing the banks to come and to fund it, because these banks have been making huge profits. There is no shatara in the way the banks have done profit in Lebanon. None. There is no value-added service, very little value. I'm sorry to be critical. Very value-added services. So I don't know, how many bankers do we have? We have no bankers? Good. So it is, but there is no. I mean, basically the banks have made their money from funding the government by taking your deposits, and they're living on the spread. This is it. So it's not earth science, So they're relying on. So Riyad Salemeh came back and said, look, you've made so many hundreds and billions of dollars in profit. It's time for you to come back to the community. So be safe. And on top of this, I'm giving you a present. I'm guaranteeing 75% of your money that you're funding into these companies. So for the banks, some of them were very forthcoming, others had to be twisted a bit, but at the end they had no choice. This is part, they've made their money, it's their due to be able to contribute to the Lebanese ecosystem. Okay, so we have now, any other questions? Selection. The due diligence is basically a list of questions and documents that we go through. And we make sure that we understand your business, we understand your plan, we understand your team, we understand your customers, we understand how you're going to respond to these customers. So this is part of the due diligence. So it's a series, and there is a whole list. you have a checklist of all the documents that I, as an investor, I'm going to ask from you. From not only your certificate of incorporation, your shareholder agreement, your business plan. I'm going to ask who are your bankers, who are your lawyers, who are your auditors. I'm going to ask for your audited statement, if you had some audited statements. Who are your advisors? Talk to them. Who are your customers? Who have you piloted it? Who have you talked to be able? So all these people, and this is part of the due diligence to make sure that when she is presenting her projections, these projections are real. So typically what happens is I do what we call a term sheet, which is the next step. The term sheet is saying I'm willing to invest in your company. I'm willing to invest on your valuation of $1 million subject to the successful completion of the term sheet. Then I get to the term sheet and I realize that her finance guy have stolen money from her back 6 months ago. I realize that her production facilities are in the basements where you have maybe not the best health conditions around it, on it. I realize that she owes a lot of money that has not been reported on it, but on a personal basis, on a company basis, so this is putting straight. So all these things come up with due diligence. So then I come up and I say, Rima, $1 million was based upon the successful completion of your due diligence. My due diligence found out that there is 1, 2, and 3 that are not aligned with what you have told me. So I review it, and instead of $1 million, I'm valuing you today at $600 million. So this will be the process. So the due diligence is here to validate what you have done and to make sure that what you have done is a representation of the reality that you had. And this actually, in some cases, in a number of cases, we will go back and we'll review the valuation based on the completion of the due diligence. And a due diligence could take a month, but for big acquisitions, it could take several months because you have a lot of information that needs to be put in place. Our friend Salemeh was also in investment banking. In this process, it could take a year. It could take a year and a half. I worked for HP. I was in HP when HP decided to buy Compaq. At the time, in the early 2000, this process also took a lot of time. So these are depending on the companies. But even if you're a startup, even if you're only starting, it is going to take time to be able to go through the process. And I would say at least a month to do a proper job in due diligence. So this is phase 9. Any questions? At this Hana? Okay. So the other is the term sheet. Once you've done all these steps, the term sheet basically sets the condition. I'm investing in you. I'm putting 500,000. We agreed on a valuation pre-money before I put the money of 800. So 800 plus 500 is 1.3 million. My 500 divided by 1.3 is my share in your company. Now on this, not only I'm giving you the money, this is what the money is going to be used for. This is how much I value your company. These are the shares that I'm going to take. And on top of this, I'm asking you, what is the information that I need from you on a regular basis? What could you expect from me in terms of responsibilities? And I have a number of clauses related to maybe future round of funding, whether I don't want to be diluted. There might be some elements where you cannot take decisions without my approving these decisions. All these elements will be set in a term sheet, and this term sheet will be negotiated with you. And with typically, you have a lawyer to represent you to protect your interests, and I will have my own lawyer to come up. And this process is important because it sets the stage upon what is the money going to be used for, how it's going to be used, and what are the conditions related to it. And this is also a good negotiation process that takes place. Now, before you get married, what should you plan? Your divorce clause. So you need to know before you have to, and you have a lot of weddings that are ready, so you have all documented. Jackie Oasis was the first one to make it. This is before most of you were born. She has specified, even I don't know how many times she would make love to her husband, but I'm joking on this. I'm not sure if I'm joking or not, but I think it was mentioned. So there is a minimum number of times that, but all this, you have to plan your exit. You have to plan your exit, and it's important because at one point in time, our relationship, we enjoy working with you. This has been great. But at one point in time, I'm not only here to help you. There are a lot of other companies. So I want to take the money and be able to invest this money in other companies that we have. So at one point in time, I will exit. And I need to talk to you about it up front. So before I said, look, I am here, but I'm here for 5 years or 7 years. After 7 years, I want to exit. How do you want me to exit? Are you interested? If we do well, do you want to buy back my shares? Or can I bring somebody else to replace me? Or do you want to bring somebody else to replace? So these discussions, it's better that you have them before you get into the relationship with your partner. So this exit strategy and the related terms are also important, and most people don't even spend the time on it.